Hello, welcome all to this session. This side Abhilash. So in this session, I'm going to talk on the hire purchase financial services in India. So definition of hire purchase. Hire purchase means hiring of an asset for a period of time and at end of the period purchasing the same. This is the time sharing of the asset. The person hiring the assets acquires his possession and the right to use it. As it is legal device, it is being used for financing of consumer goods and for selling consumer goods on hire purchase. The primary financial benefits of the company using a hire purchase plan include maximizing working capital, the ability to enhance the financial appearance of the company to the investor, and the potential of payment flexibility. Hire purchase means a transaction where goods are purchased and sold on the terms that payment will be made in installments first. Second, the possession of the goods is given to buyer immediately. The property in the goods remains which is vendor till the last installment is paid. The seller can be repossess the goods in case of default in payment of any installment, and each installment is treated as higher charges till the last installment is paid. Parties in hire purchase. There are two parties involved in hire purchase: hire purchaser and hire vendor. So hire purchaser, he is the customer who obtains possession of the goods at the outset and can use it while paying for it by installments over the agreed period of time. Hire vendor, at the time of ownership for goods remains with the seller called hire vendor until the hire purchase has made all the payments. Features of hire purchase. Under hire purchase agreement, the hire seller transfer possessions of good immediately to the purchaser. The buyer agrees to make payment in installments over a period of time. The ownership of goods will remain with the seller until the payment of the last installment. The hire purchase generally makes a down payment on signing the agreement. And if the purchase of the goods default even the last installment, the hire seller has the right to take the goods back without making any compensation other buyers of goods. Advantages of hire purchase. So we have a five advantages of hire purchase. The spread the cost of finance, higher realized income, fewer defaulters, recycle record funds, and higher acceptance rates. Okay. So hire purchase plan was first developed in the UK, but it is more commonly known in the US. A hire purchase is most commonly employed when a company does not wish to make the capital outlay to the purchase a piece of equipment. The company therefore signs a rent to own agreement in which it makes regular rental payments, a portion of which is applied to the eventual purchase price. If the company carries the agreement term, then at the end of the agreement it owns the equipment. Advantages of using hire purchase are the most obvious benefit of a company in using a hire purchase plan. It is does not have to pay the full amount of purchase upfront. So praise the cost of finance. This can be very beneficial for company that needs to obtain expensive equipment but does not have the necessary capital, do not want to increase in debt burden by following money. Company can sometimes manage to keep the money used for lease the equipment and the equipment of their balance sheet, thereby providing better looking return on assets, so higher realized income. Another financial benefit of using a hire purchase plan is that such plans often include maintenance in the contract. So recycle recover funds. So the company does not have to worry about having to pay for any expensive repair costs that may arise. Expensing the rental payment may be more tax advantageous than buying and depreciating the equipment. A hire purchase plan is also beneficial in that it does not obligate the company to keep the equipment and the payment terms are often flexible. For example, if the use of equipment varies seasonally, payment can often be structured to consider with the level of uses. Lease versus hire purchase. The basis here is a lease financing, here is a hire purchase. A lease financing means a lease transaction is a commercial agreement whereby an equipment owner or manufacturer conveys to the equipment uses the right to use the equipment in return for rent. Hire purchase is a type of installment credit under which the hire purchaser agrees to take the goods on a hire at a stated rental which is inclusive of the repayment of principal as well as interest with an option to purchase. Option to user, no option is provided to the lessee who is the user who is taking the property of the rent to purchase the goods. So there is no option. But in the hire purchase, the option is provided to the hirer user to the uh, buy that rental space. Lease rental paid by the lessee are entirely revenue expenditure of the lessee. Only interest element included in the HP installments is revenue expenditure by nature. So only interest is a revenue in this hire purchase. But the leasing, the whatever rental paid by the lessee is entirely a revenue expenditure by the lessee. Lease rentals comprise of two elements: finance charges and capital recovery. Where HP installments, hire purchase installments comprise of three elements: normal trading profit and financial charges, and the recovery of amount. The third is the consumer credit. Consumer credits includes all fund-based financing plans offered to the primarily individuals to acquire durable consumer goods. In a consumer credit transaction, the individual's consumer buyer pays a fraction of the cash purchase price at the time of the delivery of the asset and pays the balance with interest over the specified period of time. So best example for the consumer credit is the Bajaj Finance home finance. Then we have a just pay online platform to buy where the consumer can use that all apps to buy a product, right? So for the first time, you have to make at least 20 to 30% payment out of the 100% whatever the price of the product, and the rest amount he can pay as in the installment with the interest rate or interest free. Home credit is there, just is there, again early salary is there, right? So there are many players, many startups are providing the consumer credit. One of the famous consumer credit financing is the Bajaj Finance. The term consumer credits refers to the activities involved in granting credit to consumer to enable them purchases own goods means for everyday use. It is also known by several names such as credit merchandising, deferred payment, installment buying, easy payment, and installment credit plan. According to the Revis-Cox, consumer credits refers to the business procedure through the which the consumers purchase semi-durables and durables other than real estate in order to obtain from them a series of payment extending over a period of 3 months to 5 years and the obtain possessions of them when only a fraction of the price has been paid off. Type of consumer credits: the closing credit, orient end credit, and advantages. Okay, so closing credit. This form of credit is used for a specific purpose of credit, specific amount for a specific period of a time. Payments are usually of equal amounts. Example, automobile loans where the agreement lists the repayments terms such as the number of payments and the payment amount and how much credit will cost. Oriented open-end credit loans are made on a continuous basis as a hire purchase items. You are billed periodically to make the least partial payments. Example, using a credit card issued by a store or a bank card such as a Visa or MasterCard, there is a maximum amount of credit that you can call line of credit and you have to repay the debt in full each month, and you also have a finance charges for use of credit. Advantages of consumer credit: enjoying possession, compulsory saving, meeting emergency, and realization of dream. Consumers can earn substantial benefits by using credit if they use it wisely. Many department stores or car dealerships offer their customer advantages financing options, including delayed payments and low interest rate. Credit cards often reward cardholders with cashback offers, frequent flyer miles, and reward points. For consumers who resist the temptation to overspend and pay off their credit card over the period of time. A credit card earning frequent flyer miles, for example, could end up buying a free vacation, but if you fall behind on credit card payments, you will pay such more interest than the card. Consumer credit is a very beneficial for a person as he can take advance to buy goods and services. Uh, in addition to this, it is also helpful for people in case of emergency. For example, if a person car breaks in an accident, then he can use consumer credit to repair his car rather than waiting to save money to get his car fixed. Consumer credit is also beneficial for an economy and it helps in its growth and also makes it in becoming a cashless economy. However, moreover, consumer credit also improves the business of banks and other financial institutions as more and the more people are using revolving consumer credit for the purchase of things of their day-to-day use. So, right. So here we are done with the of advantages of financial credit. Thank you. Best wishes.